Welcome to the Pro Ticker Deep Dive. Okay, let's unpack this. When most people, look at the pharmaceutical sector, they probably see stability, maybe a defensive investment.
Uh-huh. Maybe even a little predictable, a bit boring sometimes.
Exactly. But the data we're seeing from the third quarter earnings season suggests, well, a much more complicated picture. This industry is facing some serious headwinds. You've got persistent inflation, major cost pressures, huge policy shifts.
Yeah, especially in its biggest market.
Right. And yet somehow it's still being called a quiet outperformer. It's actually beating the broader market.
And what's really fascinating here, I think, is how the whole narrative is shifting. For years, decades even, the big pharma story was all about, dazzling R&D breakthroughs and almost unchecked pricing power.
Blockbusters and price hikes.
Pretty much. But now, the focus is almost entirely on strategic endurance, operational discipline. So our mission today is really to dig into the source material, figure out how this industry is managing to navigate these complex macro challenges.
And find those new engines driving resilience.
Exactly. What's keeping them going?
So that brings us to the core tension, the big question for you, the listener. Can big pharma keep up this high performance when regulators are really starting to clamp down on drug pricing? And at the same time, you've got tech like AI basically redefining how innovation even happens.
It's a balancing act, for sure.
Okay, let's start with that foundation then. Resilience. Looking at the financials, our sources show revenue growth across the big players is, well, modest. Mid-single digits, often.
Yeah, nothing spectacular on the top line.
Right, but that number seems to be masking some powerful shifts happening internally. So if revenue isn't exactly soaring, what are the practical steps these firms are taking, inside the company to keep those margins steady or even grow them?
Okay, so the main thing here is a huge renewed focus on capital efficiency, smarter portfolio management. The jargon they use is operational leverage, and it's definitely back in style.
Operational leverage, meaning?
Simply put, squeezing more profit out of the assets and infrastructure they already have. They're getting really disciplined on costs. R&D spending, for example, it's normalizing after that huge spike during the pandemic.
Makes sense.
And importantly, SG&A, that's selling, general, and admin expenses, they're being trimmed pretty aggressively. You put that together, and it signals real financial stability. We're even seeing several key players guiding for margin expansion out to 2026.
Wow, okay, so that discipline deals with the internal costs. But what about the bigger picture, the macro environment? Every multinational is dealing with that. Did pharma get any external help this quarter?
They did, actually. A bit of a quiet cushion. For companies operating globally, a weaker U.S. dollar is almost always good news.
Right, the earnings translation.
Exactly. And the dollar's mild depreciation this past quarter, it provided a pretty meaningful earnings tailwind. Our analysis suggests that for every 1% the dollar index drops, it gives a sector-wide boost of maybe 0.5 to 0.7% to earnings per share.
Huh. Subtle, but definitely helpful when margins are tight.
Absolutely. It adds up.
Okay, that helps with the currency side. But let's go back to the supply chain for a sec. We're still talking about global inflation. How are managers handling those higher raw material prices, especially for APIs, the active pharmaceutical ingredients, the actual drug stuff? Are they just absorbing those costs?
Well, they really can't afford to just eat those costs entirely, and this is where you see that strategic de-risking kick in. High raw material prices, particularly for APIs, plus sticky high logistics costs. It's forcing management teams to quietly but seriously rethink their whole production footprint.
So moving away from
relying so heavily on, say, China for some of those foundational ingredients, we're seeing a clear strategic shift. They're diversifying production into places like India and also Eastern Europe.
trading maybe a little bit of cost for more security.
That seems to be the calculation. They're prioritizing long-term supply chain security over maybe saving a few pennies in the short term.
That makes a lot of sense strategically. Okay, let's pivot now to maybe the biggest shift, especially in the U.S. market policy. For you, the investor watching this space, that psychological shift from new policies like the Inflation Reduction Act, it seems huge, even if the immediate revenue hit isn't massive right now.
It's huge because it sets the tone, not just in the U.S., but globally. These new negotiation frameworks for drug prices.
Right.
Yeah, the immediate impact might be limited to a few older, high-cost drugs for now.
But the signal it sends.
The signal is undeniable. That old expectation of just unlimited pricing power in the huge U.S. market, that's gone. And that forces a rethink of everything R&D investment choices, how they approach international markets. It just introduces this policy uncertainty, this overhang that wasn't really there before to the same degree.
Okay, so the U.S. market is adapting to price constraints. How does that compare then to Europe, which has always been tougher on pricing? And what about emerging markets? They used to be almost an afterthought sometimes.
Right. Well, Europe is actually accelerating its move towards what they call value-based reimbursement models.
Value-based,
Yeah.
meaning payment for outcomes.
Exactly. It's critical. Instead of just paying for a pill, European systems increasingly want to pay for measurable patient outcomes. Did the therapy actually work as promised? This pushes pharma to generate much more real-world evidence, prove cost-effectiveness.
Interesting. And emerging markets?
Emerging markets are becoming this sort of hidden growth engine, specifically places like India, Brazil, Mexico. They're showing really consistent double-digit expansion, but it's in branded generics. It's driven almost purely by volume demand, even where pricing is super tight.
So volume over price there. What about China? It's still a big piece of the puzzle.
China's still mixed. You are seeing hospital sales bounce back, which is good. But margin pressure continues because of those aggressive government tender programs squeezing prices.
Okay, so the picture emerging is definitely one of agility, strategic shifts, replacing just raw pricing power. We've covered policy. Let's turn to the actual products, the engine room, because two areas just dominate the conversation right now. The so-called obesity gold rush, and maybe the maturing oncology space. Let's start with the one everyone's talking about, GLP-1 therapies.
Yeah, the GLP-1s, I mean, what started out as a pretty niche diabetes treatment is now driving probably the strongest revenue acceleration the sector's seen in, well, years. Demand is just off the charts, still exceeding supply globally.
And the story's getting bigger than just weight loss, right?
Absolute crucial point. The narrative is shifting very fast from just weight loss to comprehensive metabolic health.
Yeah,
We're seeing early but very promising clinical data showing significant benefits for cardiovascular health, for kidney health.
game changer.
Total game changer, because those wider benefits, they justify keeping prices relatively high. And more importantly, they argue for much broader insurance coverage. Suddenly, these aren't just lifestyle drugs. They're potentially massive, long-term chronic care franchises, affecting billions of people.
Okay, that certainly explains the excitement and the high valuations for those specific companies. What about the traditional powerhouse, though? Cancer treatment. Oncology has been the bedrock, the highest margin business for ages. Is it still the main driver?
Oncology is definitely maturing, and the business model there is shifting too. You're seeing older blockbuster biologics, really successful drugs, getting hit hard now by biosimilar competition.
So complex generics, basically.
Essentially, yes, large molecule generic versions. And they're really compressing prices on those established product lines. So the innovation focus now, it's less on broad spectrum chemo and much more on personalization. Things like cell therapies, really sophisticated genetic profiling, liquid biopsies.
More targeted.
Much more targeted, data-driven. So the race in oncology isn't just for growth at any cost anymore. It's about sustainable leadership built on efficiency, better data, proving value. And margins are actually improving in some areas because of better manufacturing scale and smarter clinical trial designs.
So trading some of that old volume growth maybe for efficiency and tech deployment, that actually leads perfectly into R&D. Our sources are highlighting a pretty big shift in spending there, too, moving away from those huge decade-long internal pipeline bets. How are these, let's face it, historically slow-moving giants getting, as they say, smarter, smaller, and sharper in finding new drugs?
Yeah, they're definitely adopting more of a venture-style approach to R&D, less trying to do everything massive internally.
Meaning?
Smaller bets, more external focus, quicker decisions. They're setting up way more collaborations with nimble biotech startups. This dramatically cuts their internal capital needs, right? Lets them spread the risk across dozens of promising early ideas, and then they only bring the most successful ones fully in-house for the expensive late-stage development.
Okay, and this feels like where the tech story, especially AI, gets really concrete. We're seeing actual measurable benefits from artificial intelligence and machine learning in drug discovery now. This isn't just hype anymore.
Oh, not at all. It's becoming a structural improvement to their whole cost structure and timeline. If you connect the dots, AI and ML are getting really good at identifying promising drug candidates and screening out likely failures much, much earlier.
How much earlier? What's the impact?
Well, some of the early adopters are reporting things like up to a 40% reduction in the time it takes just to screen molecules. Think about that compound effect. If AI can spot toxic or ineffective compounds way earlier.
Saves years and millions, potentially billions.
Exactly. It prevents all that wasted capital down the line, this kind of process innovation. It could potentially turn a traditional, say, 15-year drug development cycle into something more like a 10-year cycle. That's a massive shift in the time to revenue and the lifetime return on investment for a drug.
That efficiency gain is, yeah, pretty incredible. But it doesn't mean risk just disappears, right? So as we look out over the next, say, 2 to 3 years, how should you, the listener, balance these huge opportunities against the key risks the industry is still facing?
Right. It's definitely a balancing act. The biggest opportunities, I think, are pretty clear. First, that metabolic market expansion we talked about, those potential heart and kidney benefits, could realistically double the addressable market for GLP-1s in maybe 5 years. Huge.
Okay, number one.
Second, that AI-powered efficiency we just discussed, leading to leaner R&D pipelines with a higher probability of success. And third, don't forget that steady, non-cyclical volume growth coming from emerging market demand. That's a nice, stable base.
Okay, opportunity's clear. On the flip side, what keeps executives up at night? What are the most pressing risks that could, derail things?
I'd point to 3 major threats. First, that policy overhang from the U.S. drug price negotiations. It's not going away, and it really intensifies heading into 2026. That's a structural risk.
Got it. Policy.
Second, the looming patent cliffs. Several really key blockbuster drugs, especially in immunology and oncology, are set to lose their exclusivity in the next 24 to 36 months. That requires serious pipeline execution to fill that revenue gap. It's a constant race.
Patent expirations, always a factor. And third.
Third is actually a nuance around the GLP-1s themselves. Manufacturing constraints. It's a classic double-edged sword. If these companies expand their manufacturing capacity too slowly, they leave huge amounts of market share on the table for competitors.
But if they build too fast?
If they expand too aggressively, they run the risk of creating a global oversupply situation by, say, late 2026, which could pressure prices. So threading that needle on manufacturing scale-up is critical.
Okay, policy, patents, and production bottlenecks. Given all this complexity, though, our sources suggest there's actually been a positive psychological shift among investors towards the sector recently. Why are investors seeing value now, despite the risks?
Yeah, I think it comes down to valuation primarily. Large-cap pharma right now is trading around, call it 15 to 17 times forward earnings estimates.
Which is?
Well, it's pretty much in line with the sector's historical average, but importantly, it's still noticeably cheaper than the broader S&P 500 multiple, which is closer to 19 or 20 times earnings right now.
So relatively attractive.
Relatively attractive, yes. And I think investors are sort of rediscovering that pharma isn't just a defensive safe haven play anymore. It can be what some call a profitable compounding machine. You get highly predictable cash flows, pretty reliable dividends, often near 3%, and consistent share buybacks. Essentially, you're paying a reasonable price for durability and predictability in what's still a pretty volatile market.
Right. So the core message for you to take away from this deep dive really seems to be this. The old era of easy money from just unchecked pricing, that's over. It's been replaced by a laser focus on smarter operations, strategic agility in R&D, and really embracing technology. The path forward looks like one of disciplined growth and continuous adaptation.
And maybe the final provocative thought for you to consider is this. We live in an investment era that seems obsessed with, high risk, often volatile hype cycles. How much value should we actually place on a sector whose ultimate competitive advantage might just be reliability and the ability to adapt? The next phase of success here really hinges entirely on execution. Which companies can consistently turn that complex scientific potential into predictable, durable profitability quarter after quarter after quarter? That's the trillion-dollar question.
See you all in the next Pro Ticker Deep Dive.